How's it going, everyone? This is a follow-on podcast from the last podcast that we did where I had picked 3 shares that I would buy. I had given my reasons on why I would buy, and then Grandad gave his opinions from his vast investing experience on why he would or wouldn't buy those shares. So for this podcast, what we're going to do is Grandad has given me 3 shares that he has dealt with previously, and I have to go and make a decision on whether I would or wouldn't buy them. So the first share that we're going to be looking at is a company called Adecco Group. So they're a Swiss-French company based in Zurich, Switzerland, founded in 1997, and they're the world's largest provider of human resource services to businesses in Europe, North and South America, Asia Pacific, and North Africa, and employ approximately 32,000 people. So their primary listing is on the Zurich Exchange. Their market cap is 6.12 billion euro. The price at the time of this recording was 31 franc. Their dividend yield was 7.8%. The payout ratio, the payout ratio for trailing 12 months, 142%. Their PE ratio is 18 times. The EV to EBITDA ratio was 10.76 times. Their beta was 1.36, and the RSI 31. And from my research, the analysts have rated a hold. Their sector type is highly cyclical, as it's a business service. So then my decision on this one was that although it's a big company and they pay a nice dividend of 7.8% with a consistent payout record since 2009, the payout ratio is very high for last year of 140%, which would indicate to me that a dividend cut is likely, as the dividend is also high. Also, from my research, their earnings were down 12.8% from this time last year, which is probably due to people being hesitant in switching jobs as there is economic uncertainty. So my conclusion to this one, Grandad, is that I wouldn't buy it. What's your opinion on it?
Well, first of all, one of the things that's of interest to me is the RSI, which you're saying is 31. And if people continue to behave as they normally do when the RSI is down around 30, you'd expect the actual share price to rise. The second thing is that the analysts are only predicting a reduction in the dividend of 5.5%. So the dividend is expected to be more than 7% again next year. Now, no company is going to continue paying 140% of their profits out each year. So why are the analysts comfortable that the company is going to pay out 7% more next year if in fact it's almost 140% of profits? They must believe that the profits are going to be better next year. Now, so I think you had said to me when we discussed this offline that the company has bought another company in the UK.
Yeah.
It may be that depressed this year's earnings in terms of all the work they had to do to purchase that company. Or it may be that this year's earnings will be greatly enhanced from the new company that they're bringing in from London. But I have these shares. I'm a little bit nervous of them because they're a small company in Switzerland, a place I've only been in about twice. So I'm just a little bit nervous of them. But because the analysts are holding up the dividend and I'm a dividend junkie, I'm willing to give it a shot. And it would be on what I describe as my watch list. If I was actually Adam, would I buy the share? I might wait a little while again to see if the fog lifts and either Grandad's shares is going to tank, or the analysts are right and that things are going to improve.
Yeah.
What would you say to that?
I would agree that it would be an attractive share, but I don't think it's attractive right now. And I'll tell you why, Grandad, because the news coming out that their earnings are down 12% is quite alarming. I also think that with the uncertainty that's ahead in the next few years, I think I could now. Although you said they're going to hold their dividend at a relatively or at a high yield, I think the uncertainty in the years coming might give me some unrealized losses if I were to buy it now. So
Yeah.
I think I would wait a couple of years before I would buy it. Now they are, as it says here, the world's largest provider of human resource services and employ 32,000 people. So they're not going to go anywhere anytime soon. But I think from my risk appetite being a young lad, and I know, stereotypically the young lads have a higher risk appetite, but for me not, wanting to lose any money, I don't think it would be something that, or I don't think it would be a good investment for me right now.
Well, I have two reactions to that.
Yeah.
Okay. The first one is we have agreed you shouldn't do anything now. Okay. And secondly, you are, when you're taking your investment decisions, very influenced by the future rather than the present. And that's correct. As I say in the book, investors need to invest in the future of a business, not be heavily influenced by the past. However, there is an issue around paying out 140% of profits.
Yeah.
I believe most companies will tip off the analysts at some stage. You know that the Swiss companies, being European, only pay a dividend once a year. And they paid it, I think, around April, May. So it's early days yet for them to actually give any nod and a wink on the dividend. But surely within 6 or 8 months, they'll be must be leaking something out on the dividend. And if they are, and the analysts are still holding to the 7 point, whatever it is, percent that they expect the dividend to be, then there's a case to say, right? And if the RSI is still down around 30, then there's a case to say maybe, I think waiting 2 or 3 years to do something about it is very long. I think you'll get some information within the next 12 months. Mightn't be the right information from my point of view, but something will break on that company within the next 12 months that would either tell you you were right or tell you Grandad was wrong.
Interesting.
Would you agree with that?
I would. Yeah, I'm kind of waiting for the blood in the streets. That's the kind of saying that I always go back to, which we discussed in the very first podcast. As Rothschild said, buy when there's blood in the streets, and I just don't think there's enough blood yet.
Did you know that the Swiss Central Bank have already dropped the interest rates twice in the last 2 or 3 months?
No, I didn't.
So, in fact, they're expecting. They believe that the Swiss economy is starting to boom. If they're, I beg your pardon. The Swiss economy, the inflation and all that's starting to come down, and that they believe that once that happens, the economy will turn. Of course, they're all over the world at ECHO, so they're dependent on the world economy. Yeah. But there's the odd little bit of blue sky to be seen around it, but not enough, I believe, at the moment for you to get into it. But, if you're watching it like a hawk, put it on your watch list. And if you get something that gave you something, go in fairly quick then, because that becomes then a bargain share. Yeah. And you were saying to me that, if you're going to invest in something, you have to take risk. I think the risks are too high at the moment, but they may narrow and decline over the next 6 or 8 months, in which case it might be a good share to go in. So we're in agreement, certainly in the short term. We're maybe not in agreement in the medium term, but I think over the next 3 or 4 months, nobody knows.
That's good anyways. Okay, we'll move on to the next share. So the next share is Banco Santander. So
Right.
Banco Santander is a banking services company which engages in the provisions of banking services to individuals, companies, and institutions. It operates through the following segments: Europe, North America, South America, and digital consumer bank or banks. Their primary listing is in the Spanish Stock Exchange. Their market cap is 76.2 billion euro. The price is €4.33. Their dividend yield is 3.21% with a payout ratio of 19%. Their PE ratio is 6.51. The beta is 1.35 and their RSI is 30. However, the analysts are rating it a sell from my research. And for the EV to EBITDA, it's slightly different because I remember you telling me before, Grandad, that banks don't operate off EV to EBITDA ratios. And I have a little explanation here of why, but maybe you'll be able to clarify it a bit more, okay? So imagine a bank is like a baker. The baker buys flour, which is then borrowing money, and sells cakes, which is banks selling loans. Their profit comes from the difference between the price of the flour and the cakes, which is the interest rate spread. The EV to EBITDA ratio removes the interest costs from the picture, but for banks, interest costs are like the flour, a key ingredient in their business. So the EV to EBITDA ratio for banks is irrelevant. But there's a different one that's used for banks.
Yes,
Isn't
there
Grandad?
is.
Yeah.
There is. Well, it's used for other companies too, but it's critical for banks. The business, you talked about flour there
Yeah.
and bread. Was it bread or cakes or whatever?
Cakes.
Okay. The raw ingredient that banks use is money. And what attracts money is the interest that a bank will pay for that money, deposit interest. And then what does the bank, when it's got all this money, do? What does it do with it? It lends it to customers and to governments and to companies and households, and it lends it all over the place, okay? And to the extent that the difference that they pay on the deposit interest is lower than the interest rate that they charge on the loans. That is the interest margin. And the better the interest margin, the more profit, obviously, that the bank makes. Now, at the moment, interest rates are relatively high as central banks worldwide are trying to control inflation. And effectively, as a result of that, banks are, in general, making very good profits. However, if the interest rates do not remain high for very long, the risk is that the central banks won't be able to control inflation. So interest rates will remain long. They reckon that there might be, for example, in the United States, the interest rate is the federal funds rate is 5%, broadly speaking. In the UK, it's 4%, and in Europe, it's 3%. So, and those are historically high rates for all of those three jurisdictions. However, as the inflation is improved and kept down, then in fact what will happen will be that the interest rates will be cut. And that then puts more money into the pockets of everybody, and that allows the economies to boom up again. However, in the intervening time, if the interest rates are kept low or high very long, then a lot of customers will not be able to repay their loans. So the big risk for banks is that the bad debts will go high, and that will hit their earnings. On the other hand, with the interest rates high, that means the margins are wide. So the bet at the moment is that the bad debts won't be too high for banks, and that the margins will be very sweet. But in time, then the margins will decline as the interest rates are falling. But at that stage, more people will borrow because they have more money now in their pockets, and they'll borrow to change their car or to change their house or to invest in their businesses and so on and so forth. So that ratio is called the price to book multiple. And if the price to book multiple, you know the way I like to use 1 for the beta and 1 for this and 5 for this and 10 for this. The round number for banks is 1. If the price to book ratio is 1, that means the market expects the bank to have very normalized low bad debts. If the price to book ratio is high, if it's over 1 in other words, then that means the market expects the bank to have very, very low bad debts and extraordinarily low bad debts. And if the market price to book ratio is say half, then in that instance that means that they expect the bank to have very high bad debts. So the Banco Santander price to book ratio, you worked it out, didn't you there? What was it?
It was 0.64.
So 0.64, which is a little bit on the low side. It's quite a bit off the 1. So we have to ask ourselves, is that a reasonable price to book ratio? Well, I would have thought that it depends on what's going to happen over the next year. If interest rates fall, then what will happen will be the danger of bad debts disturbing Banco Santander to an abnormal degree will go away, in which case the share price will go up. Because not only will the margin decline, but the Banco Santander will be able to do more loans to actually compensate for that. So the hope would be that Banco Santander, that the share price will go up.
I think they would be a decent buy. I think it's looking strong, in my opinion, from my risk appetite.
As you know, I'm a dividend junkie. And the dividend yield for Banco Santander is about 4. And that's low. And I've been holding on the basis that they might increase it because of the interest rates going up. But they haven't made a material increase in it. So I think over the next year, that's a share that I will get out of.
Oh, really? Okay.
Because I'm a dividend junkie.
Yeah.
And, I'm not betting. I don't really bet on share prices going up hugely, right? I'll probably hold it for a little while, but I'll be of a mind. I think I've already sold a small amount of it. I'll sell another bit of it sometime in the summer and gradually get out of it. I might leave some of it in at the end, but I have a bit too much in there for my appetite. I want more dividends.
That's interesting. Okay, so we have a different view on that one, actually.
Yes.
Because
again, in my case, just to say to you, Adam,
yeah,
it's slowly catch your monkey. I'd be selling my Banco Santander, but not tomorrow morning. I'd be selling a bit here and selling a bit there. I'd probably be gone by this time next year, or maybe even, or what I intend to sell will all be gone by this time next year, and possibly earlier than that.
And the main reason for that is just because of a low dividend.
Yeah.
Interesting. Okay, so we'll move on to the third and final share. The third share is Total Energies. So Total Energies engage in the exploration and production of fuels, natural gases, and low carbon electricity. Their primary listing is on the Euronext, which is the Paris Stock Exchange. Massive company, market cap 156.63 billion euro. Their price is about 62 euro. Dividend yield 4.8%. Payout ratio 36.7%. PE ratio 7.45 times. EV to EBITDA 3.88 times. Beta 0.28. RSI 63. The analysts rated a hold or a buy, and the sector type is cyclical. And this is one that I think is really attractive and I would buy. This is one that I really like the look of. They're a massive company, a decent dividend, a low payout ratio, a low P ratio, or lower P ratio than the oil and gas industry average, and especially low beta of 0.28. So it's something that I really like and I would buy it. What's your thoughts?
First of all, it's a French company. Okay, it's the big French oil company that initially, if you like, came out of the oil that was in the French colonies rather than BP, which was in the Dutch and British colonies, right? Its dividend yield is actually 4.8%, as you say, and they're not expecting a huge increase in that next year. They're only expecting the dividend, the analysts, a 2% increase in it. And 2% of 4%, or say 5%, 10% is 0.5, 1% is 0.05, 2% is about
4.9.
Yeah, 4.9. It will do well to hit the 5%. Okay.
Yeah.
On the other hand, it is a cyclical share.
Yeah.
And the oil price might, when the economy starts to grow, the oil price might give them more profits, in which case they might do well. So I have sold a fair bit of Total Energies over the last year, and I'm inclined to hold on to it, but because of the low dividend yield, I'd put it in the same bucket as Banco Santander, in that I've cleaned out so much profit from Total Energy in the last year. I might leave the rest of it in just as a diversification stock. But with Banco Santander, if I think I might have a bit more in it, in which case I might take a bit more out of Banco Santander. But it's a good share. It has done very well for me. And the P ratio is interesting. Like the P ratio for Total Energies, I don't know what figure you gave. I have a figure of 7.5. Is that what you have? Something like that. And that's modest compared to the 10 or 12. Yeah. So it's not trading expensively.
Yeah.
So there's very little downside, I would say, in that particular share.
Yeah.
So I might leave it. I don't know what I'll do. I might leave it,
I like Grandad. You know what it kind of seems like? It seems to me, the impression I get from companies with a large dividend is that it's nearly a tiny bit risky, because why are they paying so much of a dividend? Because they want you to buy the share, isn't it?
Oh, you're absolutely right. I mean,
it's alarming.
As I said to you, 5%, if it hits the 5%, I'll leave the money there.
Yeah.
The other thing is, I think I might have different, the analysts' views. What did you say the analysts' views were?
I said they were a hold or a buy.
Yes, they are. And do you know how many analysts there are?
20.
24. Of which 9 are saying, none are saying to sell. 1 is saying to,
just sit back, Grandad.
9 is saying to, 9 is saying to hold. Back. Okay, sorry. Start again then. Okay. What the analysts are saying, none is saying to sell. 9 are saying to hold, but 15 are saying to buy.
Right.
So it's heading towards a strong buy.
Yeah.
Whereas in Banco Santander, they're also saying, none are saying to sell, 7 are saying to hold, and 19 are saying to buy. So they're interesting. Those kind of statistics are interesting. I think I may, if they hit the 5%, I'll hold on to my holding. If they don't, and they don't come close to it, I probably will sell. And in Banco Santander, I'll come down to my normal $5,000 a holding in that as well, unless I get a surprise there. because I'm a dividend guy.
Yeah. It just seems alarming to me. Like I kind of am nearly more happy when I see a company like it. Do you know what, Grandad? It nearly seems as if you have a higher risk appetite than me, from what
Why
I
is
would be
that?
comfortable. Because I wouldn't really be comfortable investing in a
Deco.
company. Yeah, like it just seems too much. It seems like they're trying to
Well,
attract
Kenny.
me, and that seems unattractive that they're trying to
Well,
attract me. Do you know what I mean?
well, I think I could put your mind at rest. You know
Why?
the way I normally have 5,000 in a share?
Yeah.
I've only 2,500 in a Deco.
Oh, okay, that's good. That's good.
I just said to myself, I wonder what it would be like to get, a Swiss share that's not a bank or an insurance company. I'll have a go at a Deco. I like their dividend yield. Let's see what happens, right?
Yeah,
But I've
yeah.
only put, in other words, sometimes I try things out for size. And that's what I'm doing with a Deco.